Okay, welcome to Finance Friday, weekly wealth creation course. I'm Jerry Fetta, owner, founder, CEO of Wealth Dynamics. Coming with you again for the fourth year in a row every Friday with a course on finances. We're talking tonight about investing, okay? Private placement investing. I'm going to share with you the basics, what you need to know about that. Now, if you're tuning in for the first time, there's a couple of things that I want to go over. I'm Jerry. Again, I own Wealth Dynamics, and that is my dog Samson's tail behind me. Anyways, before we get started, I want to make sure that we set a couple of ground rules. So first things first is, as you're joining this course, I want you to have a purpose for being here. Why are you here, right? It's a Friday night, it's Memorial Day weekend. There's plenty of things you could be doing, but instead you're here. And so when I first started doing these courses, 4 years ago, the reason why I chose Friday is because to me, that showed me someone was serious about their finances, right? We used to do these in person. I used to have a 3,000 square foot office in Anchorage, Alaska. That's right. I said Alaska. And so we would have people come in on Friday night. If you showed up in my office, I knew you were serious about finances. So I was willing to invest the time to help you learn in all of these different things, right? So same thing as now is you're here on a Friday. What's your reason for being here? Tonight's topic, private placement investments, right? So you're watching this, you either don't know what that is, it interested you, you've been considering getting into them. Maybe you are in them and you're wondering what else you could be doing. There's tons of reasons I want you to have yours, right? Second thing, get rid of the idea that you can't learn about money, right? We want to get rid of the idea that we can't learn about money, that we can't learn about finances. Finances, it comes down to basic vocabulary and math, right? So if I can use a calculator and a dictionary, there's nothing financial that I cannot understand, right? And I really have to think that, because if I don't think that, I'm never going to try and understand. You see the problem there? So the thing that I want you to think about is, okay, everything tonight is learnable, right? We're gonna go over some terms and maybe some different definitions, but none of it's unlearnable. Okay. And then the other thing I want you to remove is the idea that you know it all already. Even if you're the most experienced and seasoned investor, financial professional, whatever it might be, family office owner, I don't care. There's something you can learn, right? Like nobody has reached the pinnacle of knowledge where there's nothing left to learn yet. Okay. Those that believe that, that's actually ignorance, right? So remove that idea as well. Okay. And then also I want to make sure that this is an interactive webinar. So if you have questions, drop them in the chat. If you're on Facebook, put them in the comments. If you're on Zoom, put them in the chat. If you are on Zoom, we'll mic up and actually go live together, and I will answer your questions as they are asked. So every 10, 15 minutes, I try and take a break and answer questions. Okay. And then finally, I want to go ahead and introduce Nano, Aquino, and Michael Carrigan on my team. Nano is here. A lot of you guys know Nano already. I don't think we have Mike here tonight, actually. Mike is traveling. It's just Nano. A lot of you guys know Nano already. Nano is one of our very oldest, most established employees. He helps tons of our clients with getting started, learning more about how they can start to build financial independence and achieve greater financial freedom in their lives. So if Nano sends you a message, one of two things: he's trying to connect with you for a call, or he's trying to make sure that you have a copy of my book here, Blueprints of Financial Freedom, right? We're going to cover a lot of information tonight on private placement investing. Not all of it is going to get covered. So there's more to learn even after this webinar, right? So if you get a copy of my book from Nano, it's going to include not only the book, there's a course with the book. You'll get a free coaching call with Nano as well. So reach out to him in the chat. You can also go to jerryfetta.com/B2F, and you can learn more about that. Okay. So without further ado, let's get into our topic. And I have my new handy dandy stylus so we can sketch some fun things out tonight. So I want to talk to you tonight about private placement investing, right? So the first thing I want to go over is, what is that, right? What does that term even mean, right? We all understand what does private mean, right? Private means it's not open to the general public. It's not something everybody knows about or everyone gets to participate in. If you have private property, that's not everyone's property, right? So that's the first thing to look at. Now, what is a private placement? So there's a part of the security exchange laws that basically it gives what is the word I'm looking for? It gives an exemption. That's the word I'm looking for, to having to register an investment as a public offering. A public offering means you're going to go on the stock market. You're going to list with the stock market. You're going to go get investors. So you can file for an exemption saying, hey, I don't want to go on the stock market. I want to get investors, but I don't want to do Wall Street. I don't want to go on the NASDAQ. I don't want to go on the S&P. I don't want to go through, a venture capitalism firm or any of that stuff, an investment bank. I just want to raise private money. right? And so you would file this exemption with the SEC. Okay, there's different regulations you would file under, right? There's regulation A, regulation D, like there's a lot of different ones out there. But the idea with the private placement investment is somebody actually has gone and they've filed with the SEC. They have one of these exemptions. And so because of this exemption, they can go and raise money, right? So they can raise money on a deal and they can, whether it's real estate or different things, we'll talk about what they are tonight, but that's what a private placement investment is. It's a non-public offering. It's going through the SEC. It's getting that exemption, right? That non-registered filing done. It's legal. It's got what's called a private placement memorandum, which is kind of like the boilerplate disclosures and all of the things that you would look at when you're looking at these investments. And that makes something a private placement, right? Now, this is a very specific definition. This does not mean that my buddy is looking for money to borrow so that he can go buy a duplex. That's not a private placement investment. That's you loaning money to your buddy. This does not mean I have an influencer that I like to follow on Instagram that's full of hype posts and he's raising money for private real estate deals, because if he doesn't have a private placement filing, what he's doing is completely illegal, right? So there's no gray area on this. So you as the client, part of what you've got to know is I'm either doing a public offering or I'm doing a private offering. Both of them require the SEC, the Securities Exchange Commission, right? So if the SEC is not involved, these are illegal deals. I'm not the one that's going to get in trouble if I'm the investor. The fund is. What happens if the fund gets in trouble? The SEC actually takes over, right? They take over, they commandeer the fund. Now you've got a fund that's being run by a government organization, right? Not fun. You don't want that, right? So when I'm thinking private placement investments, like that's the technical definition. Now, most of us aren't thinking about that. Most of us, when we start investing, we're going to come in on one of two avenues, right? We're going to come in, on the retail financial services side, which is where I started. We're going to sit down with a financial advisor and they're going to tell us all about retirement and diversification and all these great things. And then they're going to sell us some basket of mutual funds or retail financial products, right? That's the first way it actually happens. The other way that people come in is they'll come in on opportunities like real estate. They'll see Robert Kiyosaki, or they'll see some guy or some person talking about invest in real estate. And so whether it's real estate or whether it's crypto or whatever it is, that's like, it's not an investment like a product would be, right? It's an investment like this is a thing I'm going to go buy and I'm going to build it and manage it and do it. And it's going to grow my money, right? Those are usually the two different ways people learn about investing. Usually people don't learn about private placement investing first. And the big reason is this. So with most private placement investments, an individual needs to have $1 million net worth, excluding the value of their primary home. And if they do not have $1 million net worth, excluding the value of their primary home, we're not even allowed to talk, right? Like you can't even be advertised to about these types of investments. So this is something that you're looking at and you're like, okay, cool. Well, I want to know about it. Well, the SEC is telling these guys that run these funds, hey, you can't tell them about it. Unless you can certify he's got $1 million net worth, this is not a subject you're allowed to talk about, right? And so that really does limit, all right, well, who's going to tell me about this, because there's all this restriction and regulation. Okay. So when you're looking at these deals, typically the first thing you want to realize is this is not something that you're going to see from a financial advisor. This is not something you're going to see from a guru. This is not something that you're going to see on an advertisement, because none of those can happen. AKA, unless I am financially literate enough or connected enough to know, I'm not even going to know to look. Right. So this was my exposure to private placements. I was a financial advisor, like a mainstream financial advisor. I was doing mutual funds and annuities and retirement planning and all this stuff. And so I sat down with somebody and I started talking to them about, okay, well, what are they doing? Right. It was a very savvy investor. One of the most successful real estate investors I know owns 0 fourplexes, 0 duplexes. Like he's not doing the model of try and get cheap loan programs and acquire real estate. And when I asked him about that, he's like, because that's not investing, that's a job. And so I sat down with them and I was like, okay, well, what is it that you do? Because this guy has a ton of passive income. And I've known him for a while. It's like, I know that this guy is wealthy. I know he's investing. What is he doing? And so what he explained to me is he owned a fund. He's like, I take private money from clients, right, from investors, and they loan it to me, or they buy into my deals. And then I put deals together and they either get their interest or they get a percentage of the deal. And this was my first exposure to private placement investing. The first thing I noticed about it, and I'm going to draw this out on the whiteboard. The first thing that I noticed about it was a lot of his deals, and this is not true with all of them, but this particular style are non-correlated assets. Okay. Like, think about, what does correlated mean? It's going along with something, right? So if I'm in a correlated asset, depending on what asset it's correlated with, let's say it's the stock market. Any stock product I buy is going to have some degree of correlation with the stock market, whether it's a mutual fund or an ETF or an individual stock, it's correlated. So when the Fed prints out a bunch of money, all the stocks are going to go up, right? When interest rates come up and they start tightening money supply and people realize these companies are actually broke and barely staying alive, all the market comes down. And it doesn't matter what I own, for the most part, it's going to correlate, right? Same thing within crypto, right? It doesn't matter what crypto I own. If I'm in that market and it rises, I'm probably going to rise with it. If it falls, I'm probably going to fall with it. Same thing, if I'm in mainstream real estate where I'm buying, typically A and B class properties, like when the real estate market goes up, I'm going to go up with it. When it comes down, I'm going to come down with it. So he was investing in non-correlated assets. This is one of the reasons why you would invest in a private placement. You want to be in an asset that's isolated. It's not attached to the economy, right? So non-correlated, an example of this is secured private lending. Right? Why is this non-correlated? Because when I do a secured private lending deal, I already know my interest rate going into the deal. Like, so we helped the client today invest. He's doing a 12% deal with an investing partner of ours. And so it doesn't matter what the market does. He's going to make 12%. Right? Over the next 5 years, that's his annual return. And so it doesn't matter if the market does, negative 30, he's still going to make 12. It doesn't matter if the market does positive 30, he's still going to do 12. And so one of the reasons why somebody would invest in a private placement is they don't want the ups and downs. They don't want to be involved in 1 year I make positive 30, the next year I lose half of it. Right? They want to know, okay, I'm going to make 12. Right? If we go back to the triangle of wealth on this, here's the reason why this is important. I earn, I save, and I invest. Okay. The only variable that I want here is my active income. My savings rate should be fixed. We talk about saving 40% of your income, right? That shouldn't be something that's up and down all the time, right? My earning, it might be. I want to be able to push that up. I want a great, potential for volatility because I can control that upwards. My investing, I don't want that. I want stability, right? Investing is how I scale my income, right? I talked about on a previous course, maybe about a year ago, it's kind of like opening up franchises. If I was opening up franchises, it means that I have a sustainable model in the first place, and I'm now going to open up more locations, and I want to see predictable growth in those locations. I want to be able to project what I'm going to make. So for example, if I know I'm making 12, okay, I now know that's my number. Right? I'm going to scale my wealth, my income at 12%. So as long as I can earn it, and as long as I can save it, I can put it in these 12% deals and I know what's going to happen. Right? So this is the benefit of non-correlating your assets. Okay. So some examples of this, we talked about secure private lending. Okay. That's a good one. So we have secure private lending. Okay, another one that I just thought of, because we have a client today that had one of these pay out, is life settlement investing. Okay, this is a non-correlated asset. Okay, what is a life settlement investment? I didn't even know this was an investment for the longest time, and I was an insurance agent, right? Like, think about that. So if an insurance agent doesn't know what this is, most investors don't either. So a life settlement investment means that a elderly person owns a life insurance policy. They're paying premiums on it. They own it. They're insured by it. Somebody else is typically the beneficiary, right? You can't be your own beneficiary. So somebody else is the beneficiary. And this individual has decided, I would rather just have cash for whatever reason. It could be, because I have a medical thing happening and I need money for, cancer or long-term care or whatever it might be. It could be that I want to enjoy my retirement and I didn't quite set aside enough money. And so I need money for that. And I would rather have that than life insurance. It could also be, I want to make improvements on my house. This is my dream house. My retirement started and I want to make this perfect, right? It doesn't matter why they need the money. They need the money. They would rather have money. And so with a life settlement, somebody has cash value life insurance, the elderly individual does. And so they have two options, right? They can surrender the policy with the insurance company, like meaning they're going to say, hey, cancel my policy and give me whatever I have in cash value, right? That's a way to get money out of a life insurance policy. The other thing they can do is they can take policy loans, right? The problem is most of these are universal life insurance policies, and they were sold in the 1970s and 80s, AKA they are shit. They're terrible. These people were taken advantage of big time, right? So they have rising premium costs and they have very low growth on their cash value. So if they take loans, they have negative loan spreads, right? For those of you that are clients of mine, you know what that means. It means that they're paying more in interest than they're earning on their cash. And so it's only a matter of time before they can't afford to take loans anymore. And they're actually probably going to have less than they started with. Okay, that's the second option. The third option is they can hang on to the policy and just not use it. The problem is on a universal life contract, the premium goes up every year. So their premiums are increasing, and these are like thousands and thousands of dollars now. That's unaffordable for somebody that's retired. And so what happens is it cannibalizes the cash value and they end up with nothing, and there's not even a death benefit left over. So those are their three options. The fourth option is they can sell to a life settlement fund. Right. So what does that look like? It means that that individual is going to go to a fund and they're going to say, hey, I have a life insurance policy. Here's all the information. I would rather have cash. I will sell it to you. Okay. So I'll give you, the life insurance policy. You're going to be the beneficiary and the owner. You're going to take over my premium payments and I am going to get cash. They can get up to 4 times what they have in cash value. So if they've got 25 grand in cash value, that means if they go to the insurance company and surrender, they're only going to get $25,000. If they take a loan, they're going to get less because they can't borrow 100% of their cash value. They're going to get maybe, 95% of that, plus they've got to pay interest and they've got that negative spread happening. Or they keep the policy in force and the 25,000 slowly goes away as their premiums go up. Okay. Or we can give them 100 grand. Here's $100,000. Go do your whatever you need to do, medical, long-term care, retirement, whatever it is, have a good end of life period, like their last 5, 10, whatever years, enjoy that. Here's money for that. We're helping these people. And we're also taking the burden off of their back of the premium, right? They don't have a $2,000 a month insurance cost anymore. Okay. So what happens is this person, they go on their merry way. They have, their money, they finish their life off, whatever. And when they pass away, that death benefit pays out to the investor. Okay, kind of morbid a little bit because you're like, okay, someone passed away, right? But I want you to think about how much did you help them before, right? You gave them 3 to 4 times what they would have gotten otherwise. They couldn't have traveled or retired or whatever it is they did with that money had it not been for you helping them. They probably would have got nothing because that insurance cost goes up every year. Okay, now here's the deal. The insurance payment, that death benefit is a contractual obligation. The insurance company has to pay that death benefit. It's a contract. Okay, it's backed up by the state guarantee agency. Like there's not going to be very many insurance companies that don't pay a death benefit on a life insurance claim. So there's not this risk of does this pay? It's more when does this pay? So when somebody buys a life settlement contract, they do a life expectancy test on the person that's selling the policy because the person's aware of all of this. They're selling it on purpose. So they do a life expectancy report and they find out from a doctor, how long do we expect this person to live down to the last month? Okay, and then basically, when that policy matures, the individual, the insured passes away, the death benefit pays out. Nothing to do with the stock market, right? So I have a client that actually just had one of these paid out. Their annualized return was 17%. Okay. This was from 2018 until now. Their annualized return was 17% a year. Right now, what does that mean? This means that during 2020, instead of losing money in the stock market in spring of 2020, they made 17% on average. Right? This year, the Dow, the S&P, crypto, all this stuff is getting freaking slaughtered. They made 17%. Right? Not only that, they're in a deferred retirement account, which means they don't have to pay taxes on their growth. So the taxable equivalent is actually closer to like 23%. No market risk. Right? There's no volatility. There's none of that. It's just when this contract pays out, I get the benefit. Right? So that's another example of a private placement investment. Okay. So those are great. There's also oil and gas investing. That's a great one for accredited investors that are looking for tax benefits. You can invest in actually producing oil and gas fields. And when you do these kind of deals, you can write off up to 100% of your principal investment. I'm going to say that again. When you do the right kind of oil and gas deals, when you put, let's say $100,000 in, you can write off up to 100% of that against your income. So for those of you that are tapped out on your 401k accounts, for those of you that are, stuck in the real estate hamster wheel, trying to get accelerated depreciation and having to 1031 your properties every time because you can't sell because of capital gains and whatever, like you just do an oil and gas deal, you're out. Right? You want to show zero income, you just do oil and gas, like continue doing these deals, right? Oil and gas is not going anywhere. It's going to continue to be a profitable industry. It always has been, right? And so this is something that if you get in the right fund, you can be earning, anywhere from 10s and 12s and 15s. I've seen as high as 20s on an annual basis. And you've got tax deductibility on the entire principal amount. And then you've got residual drilling costs and depreciation happening on the income as you receive it. Right? You can do oil and gas deals in opportunity zones where you have, a capital gain you're trying to defer, and you can actually stick it in an oil and gas fund, get rid of the capital gain entirely. And then if you hang on to it for 10 years, you don't pay taxes on any of the profits either. Right? That would be another example of a private placement investment. And the point I'm trying to make, and I can only give you guys limited information because again, I can't advertise to you about this. I can't give you specifics, but I want to give you the concept that this exists. This is out there. Because what I feel like happened in the last 2 years is a bunch of people looked at the investing outlay and said, nah, I don't like what's out there. I don't want to do mutual funds. I don't want to do ETFs. I don't want to be a landlord. And so they started looking for unusual solutions. Okay, they got involved in cryptocurrency. They got involved in all these different, stable coins and everything. Everyone that lost their ass in the last month, they were looking for unusual solutions. Most of them did not know this was an option. Right? Like had they been told, hey, just wait it out, increase your income, save some more, get accredited, or at least sophisticated. We'll talk about those levels in a second. And then there's a bunch of stuff you can do that the wealthy do that the people below that don't even know about. And you don't have to put your money at risk. You don't have to buy invisible digital trinkets to do any of this stuff. Right? So here's like, and I'm going to go over a couple levels and I'll answer some questions too. Here's why I do private placements. Guys, I was in Wall Street. Okay, I know what goes on. I've been in those meetings. I've talked with the wholesalers. I've basically been bribed to write business with different companies when I was a financial advisor, and that's a normal practice there. Right? And so I don't want to invest in that because I've seen behind the curtain. I know what goes on. It's like working in a restaurant where they have bad policy in their kitchen. You don't eat the food there. Right? Like you're like, okay, I know what happens in the kitchen. I'm going to steer clear of that place. That's how I am with Wall Street. So when I decided I'm not going to invest in Wall Street, the only other place I had left to turn was, okay, well, I guess I have to buy a fourplex now. I guess I've got to buy a rental property and be a landlord. And it's a good thing that I started running the numbers on that because I saw that this is a job. Being a landlord is a job. I did not want to be a landlord. I didn't want to have a job. I didn't like the idea of tenant management. I didn't like the idea of being tied down to a property. Like, and the thing people don't tell you about rental properties is, guys, that's a business. Okay, just like any business, it doesn't start as passive income. You've got to build it up to that level. Okay, everything prior to that, you're finding the property, that's active. You're underwriting the property, that's active. You're sitting through those meetings with your loan officer, giving them documents and qualifying for loans, that's active. You're managing the tenants, that's active. There is nothing passive about that. So I looked at that as a business owner and I was like, okay, well, I'm already working 80, 90 hours a week growing my company. My cost of my time, like my dollar per hour rate is so high. It doesn't make sense for me to go to a real estate deal so that hopefully I can make $1,500 a month. Made no sense to me. So I started looking at, okay, well, what else is there? That's when I found private placements. Guys, when I do private placement investments, it takes none of my time. Okay. Other than underwriting the deal initially, looking at the PPM, which is very different than real estate. I'm not going and flying to different locations or visiting people or haggling over prices. I look at the PPM document. I look at the financials. I talk to my CPAs. I talk to my legal team, and then I invest. And that's it. And then I can grow my business and I can invest again. So it's important to know, like, there are other routes. You don't have to go retail, and then you don't have to do it all yourself. Okay. Private placement investing, it's a happy middle ground. So let me answer some questions here really quick, and then we're going to dive into some more info on these. So again, if you have questions, drop them in the comments. Let me check Facebook first. Good to see everyone. Justin, good to see you. Randy, good to see you. Andrew, good to see you. So Andrew asked, are life settlement investments only for accredited investors? How do we go about investing in these once we are able to? That's a really good question. So Andrew, to answer your question, so with the life settlement investing, I've seen both where you can do them as an accredited investor. I've also seen where you can do them as a sophisticated investor. Right now, I haven't seen any lately that are open to sophisticated. Sophisticated means you got a $250,000 net worth versus $1 million net worth. And you've done some deals, right? The word sophisticated entails you have some level of expertise with investing. So right now, the only ones I'm seeing for life settlements are for accredited. Accredited means you've got $1 million net worth, excluding the value of your primary residence. Now, with that being said, the private placement landscape, Andrew, it's been opening up quite a bit where a lot of people are coming in, like a lot of fund sponsors are coming in. And it used to be like 4 or 5 years ago, you could just ask somebody, do you have a private placement memorandum and have you done your SEC filing? And if they said yes, you knew they were legit, right? Well, people have found out that that's all you have to do to raise private money. That's all you have to do. So if you pay a lawyer $10,000 on a credit card, they will build you a fund. And then you just have to advertise to enough stupid people to put their money into it. Now, all of a sudden, you've got millions of dollars and you can earn profit sharing and fees. So, and the reason I go into that is a lot of these private placement deals, like the good ones, are starting to raise their limits. They're saying, hey, we're only going to work with accredited. We're only going to, because more and more people now know about this. And so they're trying to protect themselves from the stupid tax that all these other new guys are about to pay by coming in and basically skirting around actually having a good fund. Right. So I know that's the long answer, but I wanted to give you that info just because I think that that's pertinent. Good. So let's see what we have on Facebook, or not on Facebook, on Zoom. Sorry. Good to see everyone. Mark wants to know how to get a hat like this. So this is our Wealth DynamX hat. You've got purpose, wealth, and freedom. We have these on our website. You can also get one from Mike if you reach out to him as well. Mark says you received a second maturity last week. That's very cool. So this looks more like a comment. PPM is normally over $100,000. You get a decent return. Semi-true. So a private placement investment, typically you need at least 50 grand, right? I have seen lower than that. Now, the return is usually not linked to the amount that you're doing at the basic level. Like if you're putting in 50 or 100, you're probably going to make the same money, right? But it comes down to like, what's the minimum that the fund is allowed? It's completely arbitrary. So they get to pick. The fund gets to pick. They have full discretion over what their minimums are. So most funds, like if you're doing real estate, most funds want 50 or 100 as a minimum, because that's about the minimum cost per unit that they're going to get. If they're buying mobile homes or whatever it is that they're buying, they need at least that much money per unit, right? So that's going to be their minimum. Life settlement investing, I've seen this as low as 5,000, right? Like if you put 5,000 into a life settlement fund, that's their minimum. I've seen it that low. The idea would be, someone puts in multiples of that, but still you've got to be accredited. As far as the return, I've seen, so Michael brings up a good point on the return. I've seen on some real estate funds where there are, preferred returns, like a preferred dividend, and it's lower if you put in less than 100 grand. That really is just I don't want to call it a pitch. It's a marketing ploy. They're trying to get you to put in more money, right? They could pay you 6 with less because the same money is going in either way. It does the same thing when it gets in the fund, it grows. But they're trying to give a incentive to get an investor to invest more. Like if you put in 100, we'll give you 6 instead of 4, right? So that's usually what goes on there. And as far as returns are concerned, like the fund is the fund, the return is the return. So if I do life settlements, the total return of the fund is the same, no matter whether you put in 50 or 100 or not. It just comes down to, okay, well, how much am I going to tell you about? How much am I going to give you? Okay, good. Let's see if we have any other questions. Brooke has a compliment. Thank you, Brooke. Brooke said, not a question, but you are the one person who can talk about finances and I don't get bored. That's great. Thank you, Brooke. Yeah, so I want to jump into this next part here and continue to throw questions down in the comments. So when you're doing these private placement investments, there are 3 levels you should know about. So the first one we just talked about. So the first one is going to be a qualified investor. Right? Now, this is, if you go Google this, you're going to see a bunch of gray, mush on the internet. There's not going to be a definitive answer. This is something that I came up with as a solidified black and white answer. A lot of these terms don't have them, right? So the IRS is same way with the tax code. It's like very black and white. You got to, or very gray. Sorry, you got to take the gray and you got to make it black and white, right? They leave it gray so that when they need somebody to be in trouble, it's easy to find a person. They're like, okay, now the rule means this. We got you now, right? Because it was a gray area. So you want to make things as black and white as you can. So a qualified investor is somebody that has enough money to invest. This is a minimum of 50,000. Okay, these are on the funds and the investments that my company works with. You need at least 50,000 to invest. You need to have 6 months of reserves. Okay, we do require no consumer debt. And there's a couple other factors, but the other big one is you need to be financially literate. Okay, and these again are like, when you hear qualified, it means you're ready to invest. So after 10 years of doing this, I'm telling you, if you are not financially literate, you are not ready to invest. I don't care how much money you have. You could bring me $10 million. And if you're financially illiterate, I'm going to tell you, go away, go get educated first. Okay. I'm not going to help you make a $10 million mistake, right? So financial literacy, you actually need to have a certain level of financial literacy. No consumer debt. This one is big. So again, like we're investing for a rate of return, right? We're investing for income. If I've got 50 grand in consumer debt, I guarantee you that the income that costs me, it is more than what an investment's going to yield. If I make 12% on this 5,000 or 50,000, okay, at 12% equals $500 a month. Okay. On a credit card, that's at least 1,000, probably 1,500, maybe more. Right. So if I take the same 50 and I put that towards, okay, let me get rid of my debt, that's a guaranteed rate of return. There's zero risk involved. Okay, I'm earning that rate of return by not paying the interest, and I'm also getting guaranteed cash flow, right? And I can't say that about any investment out there. So when someone has consumer debt, this is not to be Dave Ramsey on someone, but to say, hey, this is actually mathematically not a good idea right now. You're going to do better with the money elsewhere, right? You're going to have also more of your money back to do more things with in the future. This is not about trying to out earn the interest rate on your debt on a car or a credit card. That's not how it works. Okay, 6 months of reserves. This one, I saw this a lot in COVID during 2020, not with my clients, but with other funds. Okay. People would come in, they would get advertised to and marketed to, oh, this fund's the greatest thing in the world. Put in your money. You can do as little as 10,000 or whatever. And so people would put whatever they have in cash into the investment, and then they would lose their job, or they would be deemed, a non-essential employee and get laid off, and they would have no reserves. Right. And now they're going back to the fund and they're saying, hey, I need my money back. Right. Or, they're now suing, saying, I didn't know, I need to try and sue the fund to get my 15 grand out of it. Okay. So this is the Jerry rule. I will not introduce you to my friends if you don't have 6 months of reserves. I will not be the guy who brings a client to one of my fund partners to then a year down the road have the client be like, oh crap, I need that money back. Okay. I had this happen early in my career, right? And it was one of the most embarrassing things in the world. I had a client, he had $50,000 in a retirement account. He puts it in a private lending fund. Okay. The fund does an awesome job, 12% a year, everything we talked about. And then the client gets the bright idea that he wants to go buy an Airbnb property. So he comes to us and he's like all urgent now. I need my money back. I need my money back. And he starts causing trouble. We had to then get the fund to release the money back to him. They're now out the money that they had from the investor. They had to put their own money into the fund. Not that they can't, but it's like, that's not the point. Okay. So if you're putting your last dollar in, it's not a good idea for you to invest. If you're going to be insolvent, if you lose money, it's not a good idea for you to invest. Right. And then obviously the minimum 50,000. Now, like I said, the life settlements are lower, but guys, we're not going to tell you to start on life settlements. Okay, you need to start with something that produces passive income. Life settlements don't do that. They pay out in chunks, right? So you're trying to produce passive income. I'm gonna tell you the passive income deals, you need 50. That's going to be the minimum on any passive income deal you do, right? And if anyone's offering you less, I would be very concerned, because it means that they're going to pool you and 3 or 4 other people up together to buy one unit of either a mobile home or like a really shitty single family home. Okay, you're gonna have 4 people on that property because each of them brought, $12,500 to the table. That's not a great deal, right? So 50, you're free and clear on the unit, right? 100 even better, 150 even better, right? So this is a qualified investor. The next level here is a sophisticated investor. This is number 2. Okay, the big points to know about on the sophisticated investor is you have at least a $250,000 net worth outside of the value of your primary residence. And I want to point out the house never counts on any of this stuff. The equity in your house is not part of your net worth when it comes to the SEC. They don't care. They look at that as your expense, right? So you need at least $250,000 net worth. You need to be saving 40% of your income. Okay, and then the other one is we want to see that you actually are sophisticated. So not only is there down here the financial literacy, which at this level needs to be greater than just the qualified level, but there's also going to be experience, meaning you've actually done enough volume, like you've done enough deals to say, hey, I am sophisticated, right? So if I've only ever done one deal, I'm not going to be able to say, hey, I'm sophisticated, right? Like it's my job. If I'm your finder for like a private placement deal, if I'm the one that's supposed to introduce you to the fund, I can't in integrity and ethics say, hey, yeah, this person's sophisticated, when I know you don't study and I know you've never done a deal before. You've only done one deal in your entire life, right? So here's the deal is you want to have financial literacy. This means you're studying, you've got experience. For me, after I do something, 3, 4, 5, maybe 6 times, I can say I'm experienced. Right? So this isn't 2 deals. We want you to be doing at least 3. Get the minimum. Like if you need to do more, do more. Here's the thing. It's not a penalty. The more deals you do, the more passive income you get. You should be like, hey, let me do 6, right? Let me do 6 of these deals before I try and do a sophisticated deal, because now that's 6 flows of passive income, right? 40% savings rule. What is this about? This shows us that you've got enough coming in and being set aside that you can reinvest frequently. These are not one and done deals. The point of being a sophisticated investor is to multiply your net worth to become accredited. And people who don't save money, they try and rely on the returns of their investments to increase their growth, right? They put unrealistic expectations, which is one of the definitions of speculating, for unreasonable returns to try and get growth out of their investment to compensate the fact that they're not earning and not saving enough money. Right? So at the 40% savings rule, not only is this the number 1 metric of the top 1% as far as causative statistics, I can show you a graph that shows that they save 40% of their income, and they've done that for the last 100-something years, right? But if you're saving 40% of your income, not only are you doing that, mimicking that successful behavior, we know that you're increasing your liquidity and your assets so that you can compound your wealth faster. And you're not going to be like, hey, I'm going to try and look for unreasonable returns. Okay, I'm going to try and look for quick money on my investments. Instead of 12, give me 15, and I'm willing to overlook whatever red flag there is to get the higher return. Like you're satisfied, right? And then at the 250 marker, that's your net worth, right? So most of the 250 deals are similar. You're going to need to do $50,000 to $100,000 minimums. And these are going to be, again, more sophisticated investments. They're not as simple as a private lending deal. They're not as cut and dry. So that's why there's a level of sophistication that goes with it. Okay, the third one here is the accredited investor. Okay, the accredited investor, there's several definitions. 2 of the 3 are BS. So I'm going to go with the one that I think is the one you should go for. $1 million net worth. Not including the value of your house, once again. Right? So as an accredited investor, like not only do you need to have the underlying foundation, you need to be first, you were qualified and sophisticated, you did everything you needed to do, and also you've got $1 million net worth, right? Like, and I can tell you real life experience. Early on, I used to have people invest. I would help them invest just with $1 million net worth. If they could show me that they had $1 million, we were going to go shopping for deals, right? And legally, that's allowed to happen. That's fine. But what I would see is the investments that someone does at the $1 million level do require a great deal of knowledge. They do require a great deal of responsibility. And on these accredited deals, when you sign the private placement memorandum, you're foregoing all right to say, I didn't know, or this is riskier than I thought. None of that happens there. It's not like Wall Street. Like they did a non-registered filing. They're exempt. They're exempt. It's not going to be that you told on them and the publicly traded network of stock traders and all this, tries to beat up on them in Wall Street bets on Reddit feeds. That's not how it works here. You basically sign your rights away. You say, I understand all the risks. I understand I could lose all my money. I understand this is not registered with, or this is not a publicly listed deal. I can't resell it. And so there's not any wiggle room for you on this. As long as they follow the rules, you get your hands tied. You're in the deal now. Right now, luckily, all of our deals have been great deals. But the thing is if somebody's getting into these, they need to know. They need to know how the deal works. They need to understand the finances of it. They're typically putting in larger sums. And they need to have some experience. And so it's not just, I've got $1 million, let's go do life settlements and oil and gas deals. No. You need to have that foundation of knowledge and experience and assets and other things, because, who knows, oil market tanks, you lose a bunch of money and it's like, okay, great. Well, if that was the only deal you've ever done, A, it's going to be hard for you to rebuild from that. And B, you're going to be discouraged because the only deal you ever did, you lost. You see what I'm saying? So for these accredited deals, these are awesome. You do want to get here. It is possible. It's not impossible to have $1 million net worth. Every single person watching this video, if you do the right things, you would have $1 million net worth in your lifetime. It's just math, right? Like if you can plug it into a calculator, it can happen in real life. So to get here, like there's definitely some hoops and hurdles you jump through. But once you're here, it's very rewarding, right? And again, like when you're at this point in time, that curtain gets pulled back and there are so many investments that are out there. Right. One of the trends that we're seeing is not only are we seeing great investments out there, right? We're also seeing investments that not only do they pay a good return, because every investment should, we're seeing investments that actually help. Like they're improving conditions for humanity, right? Which to me is important. I can get a rate of return anywhere. If you can give me a great rate of return where I'm not in Wall Street and I'm not a landlord, and also you can say I changed someone's life because of what I did, I love that. Right. An example of this, we have a private placement fund that we're working with that they purify water. They've figured out how to purify water. And so they have a system that they can plug into contaminated water sources and it makes it drinkable. So they're going to communities that don't have good potable water. Right. And they're basically, the fund invests to set these up. And then it just becomes part of the utility bill. You'd pay for water anyways, but now it's drinkable. Now you actually have the ability to use it. Okay, we have another one that's cleaning trash out of the oceans, right? Like there's so many different things out there. Like the life settlement, that's another great example. We're helping like people that took care of us, our grandparents, right? Like that age group, we're helping them financially. Okay, so I love that about a lot of the accredited deals that we're doing is it's not just here's your rate of return for your spreadsheet. It's like, okay, you're actually making a difference in improving conditions around you as well, right? So those are the three main levels, right? And so when you first start out, there's going to be the okay, I'm getting solvent, I'm building up to the point of being able to invest. And then it comes to the juncture of, okay, well, it's time to start investing for passive income. And you're either going to go the private placement route or you're going to go like the turnkey route if you're looking for true passive income. And what I mean by that is you're either going to invest in a fund, and that fund, if they're doing a good job, they're going to build up that passive income for you. You don't have to go look at properties and all this different stuff. Right? You just invest and that's it. Or you can do turnkey. Okay. Turnkey means that you're going to find a vendor. They're going to help you find, if it's private lending, it's going to be real estate. They're going to help you find either a rental property or a single family home, and they're going to manage it for you and do everything for you. And then you're going to get the cash flow at the end. Okay. Both are viable options, but that's typically where you're going to start, one of those two areas. I would avoid putting money in a REIT, real estate investment trust. You don't want to do that. You don't own the real estate. You own shares of paper in a mutual fund. The mutual fund owns the real estate. Right? I would avoid doing, crowdfunding platforms. I would avoid all of these different things you could do. I'm telling you, when you first start, those are the two routes you should look at. You should not look at other routes. Right? If you look at other routes, you're either going to be stuck in a deal that pays you very mediocre returns and you can't get out of, or you're going to be trading your time for money because you became a landlord, or you're going to lose money because you went into your buddy's friend's cousin's deal who didn't file with the SEC. Right? And this third point I want to stress, and I'm going to open up for some more questions. This third point that I want to stress, like, guys, don't just look for returns. I'm going to let you in on a secret. Anybody can say they have a rate of return. Anybody can pitch you and say, hey, I can make you X amount of money. Okay, anybody can produce testimonials of other people they've done that for. That was what Bernie Madoff did. Okay, like he had a great thing going as far as he was able to get investors in the fund and they all gave him referrals and everything. And he had the reputation and he was working with politicians. So none of that shit matters. It's, are you actually overseen by the regulators? Okay, I had a client text me today asking about a pretty big influencer's like investment opportunities. Like, hey, should I do this deal? And I was like, as far as I know, this person has not filed with the SEC. When I asked them about it, they blew me off. Right? And you don't know that unless you know. So that needs to be the first question you ever ask if you're investing in a fund. Show me your SEC filing. Okay, you can actually go on Edgar. It's an SEC website. You go on the Edgar website, you can go look it up. And if you don't see them, like that should be now, okay, I need to start pulling that string to find out. Right? Because that's like a big deal. That's oversight and regulation. Now, the other thing I want to go over before I open this up for questions is sequence, right? You want to build wealth as a sequence. It's not, there's no silver bullet. So these accredited deals is the equivalent of having a great supplement to a workout and nutrition program, right? If you're not working out and you're not eating well, the supplement can't help you, right? It's not the magic rocket ride to financial independence. So there's the basics that I need to be doing, and then these can enhance the basics. A lot of times what happens with these, and it's exciting stuff because I've been there too. When I first heard about them, it was like, man, I'm in Willy Wonka's chocolate factory, like running around and seeing all these magical things I didn't know about, but it's with finances instead. And so it's exciting. And I'm like, man, I want to learn more. I want to do these and I can't wait. But the thing is these things can't make me wealthy. Okay. What makes me wealthy is behavior and math. Right. And also my literacy level, my vocabulary. So if I know the math, the vocabulary, and the behavior, that will make me wealthy, even if I don't do private placement deals. Right. Now, if I do them, great, it's going to enhance things. Right. But this is not like, okay, well, let me cut all of the corners. Let me skip all of the steps so that I can try and get into the accredited deals first. Guys, I have a client, and I won't say any names, but if he's watching, he knows who he is. He lied a couple of years ago and said he was accredited because I wouldn't let him do my deals because he wasn't accredited. He bypassed me, lied about it, went to an oil and gas fund, and guess what? He hasn't gotten his money back. Right? Like most of the stuff I'm saying on this webinar, it's not going to mesh with what the guy on TikTok says. It's not going to mesh with what the guy on Instagram says. It's not going to mesh with what the guy at the real estate meeting that's trying to get you to invest with says, because I'm telling you, slow down. When you get into these private deals, it is very hard to get out. If you lose money, it is very hard to prove it was their fault, right? Like the SEC, it's like the IRS, they don't have enough people to actually handle all of the dishonesty and rule breaking that happens in this space. So the best way to make sure that you don't get taken advantage of is go slow, right? I did a podcast a couple of months back, I think in 2021. I was talking to a guy and he's talking about the private deals. He's like, yeah, but the problem is you've got to find the right ones. Right. I was lucky that the first one I ever did, I've known the guy since I was 12. He's been doing this for 40 years. Right. His son is my best friend. There was very little like trust that I had to build because I already had that. I knew that this person was doing the right thing. So I had the in. And so over the years, I have built up my repertoire of these are the people I do business with. These are the people I trust. Right. But if I were to go on Google and just type in private investment opportunities, like, let me tell you what, there's no shortage of them. Right. If I post on Facebook groups and I say, hey, I've got money to invest in my IRA, I'm looking for real estate deals, everyone's going to tell me they have a deal. Okay. Because at the end of the day, this is about who has the most money at the end, who's built wealth at the end that sticks around. Right. Anyone can get into a deal. Anyone can say they're getting a return, but in 10 years, do you have it? Is the fund still going to be around? Right. the final factor, I know I keep saying this before I answer some questions. The final factor too is when you're doing these private deals, you want to invest in a fund that's been around for a long time and they're not based on a deal maker. Okay, what does that mean? If you've got one guy and he's the face of the fund and everything happens because of this one guy and his specialized skill set, what happens when that guy dies? Your investment is done, right? They're not their fund. They can't duplicate it, right? So I want to invest again. If it's a franchise model, I don't want it to be, you know, the one guy that knows how to run the office that nobody else can run, the one guy that knows how to make the restaurant produce and nobody else can duplicate it. I want boring funds that have consistent residual business models that are going to carry on from generation to generation. The oil and gas fund that I invest in, they're going on their third generation now, which means the founder died, the founder's son died, and now the grandkids have taken over, and it's still the same fund. It's still the same principles. It's still the same everything. Right. The other fund I invest in, the private lending fund, they're also second generation. The kids are running it now. Like the guy that found it, you know, he's got his wife doing it. He's got his kids involved. Like it's something that's going to carry on. They've got systems in place. It's all turnkey at this point. But I don't want the dude that's whipping his pistol around, you know, be doing all these exciting real estate deals. And then it's like, great. Well, what about when he's gone? Or what about when she's gone? Now I've got to go all the way back to square one and find another one. Right. So go slow. Find the right ones on the front end, and then you don't have to worry about any of that on the back end. You can just continue going, right? So let me open this up for some more questions. Vanessa has a great question. Does net worth equals assets minus debt? Exactly. So yeah, net worth is assets minus debt. What do you own minus what do you owe? And the result of that is either a positive or a negative net worth. Vanessa asks, who is Bernie Madoff? Good question. So Google that one. But Bernie Madoff, he actually died last year, but he was a hedge fund manager. He had a private fund. He was on, I think, the board of the NASDAQ exchange. He was like he had like celebrities and like, you know, like presidential, Congress, senator level politicians investing with them. And it turned out his entire fund was a fraud. Like he was basically, he was taking in investors, new investors, to pay off the old ones, and then just continuing to cycle money through to rob Peter to pay Paul. So when it was finally found out, like, you know, he robbed, like, I think it was hundreds and hundreds of millions of dollars from people. And he ended up going to prison over it. But again, like, he had presidents investing with them. Like he had like the people who run this country were dumb enough to invest with Bernie Madoff. Right. So the idea that all investors that are, you know, not flying above the radar and they're doing things that are uncompliant or whatever, you know, those are not, like, it's not going to be some slimy looking scumbag. Right? It's not going to be obvious. Like Bernie Madoff wasn't obvious. There's a movie called The Wizard of Lies, Vanessa. If you watch that, Robert De Niro plays Bernie Madoff, and it gives a good portrayal of, like, he had a good family, like they were wealthy, they were established, all of these things. Right. And so the last person you'd expect to be doing that was Bernie Madoff. Good questions coming in. Okay, let me see what we have on Zoom. Mark has more of a comment. He said, if I had the Blueprint to Freedom book 30 years ago, I would have been accredited much earlier. That's awesome. I hear that all the time. And that's a good point. I think Mark is accredited now, but if you're watching this and you are 40 or 50, like I want you to realize you still have like the rest of your life left. You're probably going to live till you're like 85, maybe 90, maybe longer, right? So you still have 30 or 40 years. You can do this still. It's no different than me being 30 and saying, okay, well, if I was starting today and I've got till I'm 60, like that's a long period of time, right? So it is definitely possible regardless of the age. You know, there is something to be said for starting young, but also with young comes, you know, distraction and inexperience. I think there's something more to be said for starting old. You've got the know-how, you've got the knowledge, you've got the responsibility, you've got the maturity to make it happen. Mark says Bernie is burning in hell right now. He might be. He very well might be. The guy was definitely scum of the earth. Michael says nobody sophisticated invested with Bernie. So you would be surprised. There were some very sophisticated people that invested with him just because they didn't check, right? Like he had two funds. He had a registered investment advisory and then a fund. The fund that they ran, the first one was legit. Like it was fine. It was his second fund, his personal advisory fund. He had that in a private office. I think it was him and his brother that were running it. And so he had a whole staff of, licensed people and everyone. They had all of the reasons why it should be a good, legitimate fund. He just kept that one off limits. And I think the story behind that is, I think like when they first started it, they had like several losses they couldn't make back, and they kept losing. And so they just started offsetting the losses with new investors. And so it wasn't even like, I don't even think the intention of, hey, I'm going to start this and rip everyone off. It was, I'm going to start this. And then it didn't go well. And I didn't know how to fix it. So I put a Band-Aid on it, and then I just never fixed the Band-Aid, and it turned into this giant thing. Right. So there definitely were sophisticated people that got in that just didn't check because they know Bernie. Right. And it's like, okay, well, just because you know the guy doesn't mean you shouldn't check. Jennifer says Wizard of Lies is such a great movie. I thought it was a good movie. Yeah, it was a great great movie and great acting as well. Casey has a question. Let me bring Casey on. He's got a question about the all-in-one loan. All right, we are live here with Casey. How are you tonight, Casey?
Hey, doing good. How about you?
I'm good. You've got a question on the all-in-one loan. Is that right?
I do.
Awesome. What is your question?
So I was wondering, when you're financing a rental property with an all-in-one for cash flow, does the balance of your mortgage count against your net worth?
Yes, that's a good question. So in the traditional sense, it would. If you've got, let's say you've got $1 million property and you've got a $800,000 all-in-one loan against it, right? Maybe you haven't drawn off of that. So that's the factor you've got to look at. If you've only drawn 500,000 of it, then you've only got 500,000 of debt that's reducing your net worth, right? So even though the credit line is available, it's different than a mortgage. The balance is only what you've drawn down. That part you've drawn down is the only part that's going to reduce your net worth. Now, if you do draw against it, that does create a negative, right? But if you take that and then you go buy an asset, let's say you invest in another deal, you've now got more equity. So it kind of offsets itself, which is one of the beauties of using the first position home equity line of credit. Jennifer says, thank you for sharing information that is always worthwhile. Absolutely my pleasure. Thank you. Good. I think that's all I see on Zoom. Let me check Facebook one more time. Good. I think that covers it. So guys, what I want to do is I want to open up a couple of things for you. If you are watching and you are, hey, I'm interested in private placement investing, one of the easy ways to do that is if you have an old retirement plan, right? So with our clients, we have the blueprint. Like we're going to tell you, hey, take your cash, follow the blueprint, right? But if you've got a retirement account where you're like, hey, regardless of the blueprint, I put $100,000 in a 401k and it was a mistake. How do I get it out? We can self-direct that and then move that into private placement investing. My camera looks terrible after that. We can self-direct that and move that into private placement investing. The other thing is if you've done like, a deal where you've got significant capital gains, you can do a 1031 exchange or an opportunity zone into a private placement investment as well. That's kind of like the IRA where it's like, hey, you already did the deal before. You're going to pay the taxes rather than, like I have a client I just talked to, rather than getting another $3 million in mortgage debt so you can be a landlord again, let's put it into a private placement deal and you can have your time back and you still get the tax benefits. So if that's you and you're watching, reach out to my team and I. If you're a established client, all the better. We'd love to talk with you about that. If you're watching it for the first time, we don't expect you to do a deal with us just because you watch my YouTube video. Contact my team, get the book, talk to us for a little while, see if we make sense and we're a fit for you. If we do, awesome. If not, no harm, no foul. Other than that, guys, if you didn't get a copy of my book yet, you can reach out to my team. You can also go to jerryfetta.com/B2F and you can get a copy of this. Otherwise, I am going to tune out. It is my birthday on Sunday, so we're going to shoot some paintball with our staff members tomorrow and have a good time. Otherwise, guys, I'll see you guys again next Friday, same time.